Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. With me, my good friend and special guest, Dr. Friday, with Dr. Friday's tax and financial firm over in Brentwood, Tennessee. You know, I mentioned she's got a radio show that she does every week on Saturday. This is on 99.7 News Talk Radio. It's Saturday from 2 to 3 o'clock. And this week I'll be appearing with her. We're going to be talking more about taxes and financial planning, how these all work together. Also on Sunday, new show, the Retirement Report on the radio. Yes. And it's on 98.3 Talk Radio and it's simulcast at the same time on Sunday at 2 to 3 p.m., 98.3 Talk Radio and 1510 a.m. WLAC. So those will be on this weekend. So you got Saturday 2 to 3 and Sunday 2 to 3. And we're going to be getting into more. This is tax time. This is a great time to be not only dealing with your taxes and getting them handled and looking for little things if we can to help minimize this tax bill, but even more important, is a great time to be looking forward and saying there are things that we can do this year to minimize taxes for this year when we go to have to file next year. So one of those that we get into, we talked about Social Security. So if you think about how you take income in retirement, in the last few weeks I dealt with a lot with tax efficient income in retirement. This is one of those times, right? So I know there are certain things that are fixed. We look at what we have to deal with. So we have pensions, for instance, what those Social Security benefits are. We know what those are. Now the taxation, though, is different. Most pension benefits are going to be fully taxable under the law. The next one is on Social Security benefits, and depending on other income, what that's going to be taxed at. And then your distributions from your IRAs. Traditional IRAs, 401ks, those are going to be taxed at ordinary income tax rates. Roth, of course, and Roth 401s, that's going to be tax-free when you take it out as long as it's been left in there for certain criteria with regard to Roth contributions. Roth conversions, the same thing. So you need to leave it in there for at least 5 years, or at least the earnings have to be left in there for 5 years. You can take the principal, you could take the principal out. Now, of course, the reality is if you're going to do the whole Roth planning, ideally is leave it in there and let it grow tax-free. It's one of the, there's only a few things in this world that grow tax-free in our country. Exactly. All right? So one of them is municipal bonds. But we know municipal bonds don't pay a whole lot, do they? And you're pretty restricted on that one. And then you got to still worry about on munis. Are you getting? There are still risks with munis. I mean, you make sure you're looking at general obligation bonds when you're talking about munis, as an example. And by the way, municipal bond interest, which is tax-free, for the provisional income formula in Social Security, you got to count it. Exactly. So that could cause you to pay more tax. Just heads up on that. Another thing is understanding how munis work. Munis don't, they're paying you a lower interest because of the tax benefits they provide, which means a taxable alternative would pay you a higher rate of return. So I mention that only because munis may not be the best thing to hold in a IRA, for instance. You're not going to get the benefit of the tax-free part, because it's already, if it's in an IRA, a regular IRA, even though it would technically be tax-free, it's going to be taxed at ordinary income tax when you take it out. So you lose that, and you're getting a lower rate compared to a similar alternative bond that you could get. All right, so that's the little things that being aware of when it comes to your taxes and how you're structuring not only for tax efficiency with regard to your investing, but also with regard to income. So now if you've got a Roth IRA and you've got a traditional IRA and you've got an outside the IRA account, that gives us the most flexibility in controlling taxable income.
Absolutely, because you can decide how to take a little from all of them, keep your tax bracket. You control the tax bracket. I wanted to jump in when it comes to he didn't quite hit it yet, required minimum distributions. Don't forget, if you have required minimum distributions, especially now under this current law where, even if you're over 70, you've got the $1,300 or $1,650 if you're single or married, plus the standard deduction of $12,000 or $24,000. So you're automatically getting that number. Let's just say you're a single guy and you're $12,000 plus $1,650, I believe it is. So was that, Hank? That's like $13,850 or something like that. You have as a standard deduction automatically. If you take your required minimum distribution and you give directly through your custodial to your church, to your any 501c3 that you like to give to. That money now is completely tax-free to you. You will still get your standard deduction, and now you've reduced your income, which may make your Social Security tax less if you happen to be one of those that are hitting the provisional income tax situation. So really, this is one of those wonderful tools I think a lot of people just don't maximize.
Yeah, I mean, we look at everything. That's why planning is so important.
Exactly.
You're taking requirement of distribution. As Friday said, there's a way that if you're giving to charity anyway, now you've just zeroed out what would be a taxable event for you. You don't have to worry about it. And this is the same thing goes, by the way, when we're looking at all of your accounts. Here's something to consider in planning for the future. Let's say you got time yet, and we're, you know, as far as planning for what kind of accounts. I just said if you got a Roth IRA, a traditional IRA, or 401k, and a non-taxable, and it's something you've already paid tax on, it's just an investment account. If you've got those three accounts set up, it gives us the most flexibility in terms of where we pull money from to maintain those lower brackets. So here's something to consider. If you're just pumping everything into a 401k, what is your current tax bracket?
Exactly.
All right? If you're in a 22% bracket or higher and you're looking to reduce that down, sure, you know, then yes. If you're in a 24% or higher bracket, if you're in a 30% or higher bracket, then taking advantage of the tax deferral is probably a good thing. And of course, what's the caveat to that? You want to make sure that your taxes are in retirement. And for most people, if you're in a higher tax bracket, and let's say, what is it, 35, 37% is the top bracket. If you're in the higher brackets, and when you retire, your income is going to be lower. And again, taxable income being lower, because there are ways that we can control that, right, is going to be lower, then yeah, take advantage of the tax deferral. We don't want to pay a higher tax when we could defer and pay a lower tax.
Exactly.
And then now here's the second part of that. We don't want to pay a lower tax today compared to what we're going to pay in retirement, or even if it's equal.
Yeah.
We might want to move some of those monies outside. So if I'm in a let's say I'm making $100,000 a year, married couple, $100,000 a year, and let's say even $140,000. Each of you put 20 into your deferred plans, okay? And now you're down in that 12% bracket. Okay, we've taken advantage and reduced our taxes on the we're not paying that 22% tax on $40,000 that we've deferred into our retirement plans. All right, so that's that's saving almost $9,000 in taxes. Now, do we continue to pump money into that, into a traditional, IRA, or would we be better off? Well, you probably couldn't with that income, but or more into 401k? No, we would just say, okay, at that point, the extra money goes into Roth. Okay, anything over and above, once I get in that 12% bracket, as long as I stay in the bracket, I'll go ahead and put money into my Roth 401k or a Roth IRA, so I'm growing some tax-free money for the future. That's going to help me when it comes to tax-efficient income in retirement. So these are some things to consider now that you can do. So when we're looking at getting your taxes right, we get your taxes filed, we look at what your tax situation is, look on what that income is, how much you're able to put into your 401ks, and we balance those kind of things out and see if that's one of the ways that you can plan for the future in minimizing future taxes as well as today's taxes. Right. Understanding capital gains tax rates. This is one of those areas that let's give them a little primer about capital gains rates with regard to being in that 10 or 12% bracket versus
yeah, so if you're in 0 to 12, it's 0% tax. Now, so again, we keep talking about married couple around $100,000. So along with, let's say you make 40 or 50 and you sell something for 25 or 30, you will have 0 tax on that capital gains because you're less than 100,000 combined income. If it happens to pop above that, you're going to go right to 15%. So if you're in the 22, they basically say the 22 to 30, 35%, yeah. I guess it is, you're at 15. And then if you're above that, so you sell something and you clear 400,000 or so, you're looking at the divisional tax of 20 plus any of those where it's $200,000 or more above your income. So a single person that has $200,000 or more in capital gains, or a married couple with 250, one of those things that has the marriage penalty involved here, you're going to have an additional 3.8%. I call it the Medicare tax. They help use it for funding. So in many of these cases, even though we're saying 0, 15, and 20, It's actually, in most of those cases, you're going to be going 0, 15 for maybe the 22 to 25% tax bracket. Above that, you're really looking at 18, 19%, and then above that, 24 almost percent, or 23.8. So there's a hidden tax, as Hank always says. We have these little hidden tax. Well, that's one of them that likes to pop out on us. And theoretically, AMT tax could kick in, which is automatically 24% if the tides are against you.
So understanding how that works, you know, this is where...
Because people always walk in and say, oh, I was only supposed to pay 15%, right? And then you try to explain, well, you had the Medicare tax, which is another $9,000, and you had this. And next thing you know, they're paying $12,000, $15,000 more than they expected. And then also, if this is rental property and you've been renting it for 10 years, you have recapture of depreciation. So even though you may have paid $200,000 and sold it for $4,000, you may have to recapture $50,000 ordinary income on that depreciation that you took. So it's not just black and white, here's the golden number. I know a lot of people say, well, I'm gonna pay 15%. It's a nice average, but the fact is there could be some hidden fees. And
this is where doing it in advance. All right, I'm planning to do this thing. I'm planning to sell this property. I'm planning, even if it's one of those things that, well, I got to do it either way. Well, it still doesn't hurt
Set the money
check and
aside.
See, you know, what that tax is going to be in advance of making that transaction, so that you can you know, reduce, at least set aside the money, if nothing else, and be practical in a negotiation of a sales price. If it's going to cost you more in tax, you might want to, that may be part of the negotiation. You know, I might want a higher price because I'm going to have to pay this tax. If you're selling off stocks, this is sometimes, you know, where we're trying to raise money for whatever reason, and these stocks are, you know, we're concerned that maybe it's a little riskier position to have, and the same thing with stock mutual funds. Well, we can look at your portfolio, and we might be picking out some things that are losers, that, you know, have lost money, that can offset some of the gains. And again, we look at what's the overall impact, you know, and we can be, just by being a little smarter in how we do these things and giving some thought to it before we just sell these things, that we can help minimize the taxes, keep more money in your pocket, basically, is what it's about. And this is one of the things when it comes to Roth conversions, same thing. Let's look and see, how much do we want to convert? What makes sense to convert based on the tax bracket you're in and what your tax brackets are going to be in the future. And then we run it to make sure we're not triggering any other things, because that's going to be, when we do a Roth conversion, of course, we're taking money out of that traditional IRA to put it into the Roth. And when we do so, that's a taxable event. We have to pay that income that we just received. Even though we're just rolling it into that Roth, that's considered income in that year, added to whatever other income we have, and taxed at the corresponding bracket that it's going to fall into, or brackets. Sometimes it crosses over. So this is understanding. We're going to take a break.
Okay. I just want to say really quick that if you do this yourself and you make a mistake, we can't go backwards now.
Yeah, that's
I mean, that's huge. So.
You know, used to be able to do recharacterizations, and no longer. So this is why it's even more important than ever
to do it right.
You know, just as Friday said, you got to get it right to make sure, because you know, you don't want no do-overs, and we don't want to trigger taxes we didn't anticipate. All right, we're going to take a break. When we come back, I'm going to get into more about some additional tax strategies, and show you how, with the way you set up your tax, when you're talking about investing, for instance, how you invest, understanding how stocks are taxed and how bonds are taxed is another great way to reduce your taxes. Okay, but first we're going to take a break. Join us here. We'll be right back on the Retirement Report.